Every single year, Australian taxpayers leave hundreds of millions of dollars sitting on the table, money the ATO is perfectly happy to keep. Not because those Australians did anything wrong, but because nobody told them what they were entitled to claim. What if 7 legitimate ATO-approved deductions have been quietly reducing what other people owe, while the tax office waits in silence? And what if one of them alone could put over $1,000 back in your pocket this financial year? This is not speculation, this is tax law, and it's time to use it. Before diving into the list, there are 3 golden rules the ATO applies to every deduction. Miss any one of them, and the claim gets knocked back, no exceptions. Rule 1. The expense must have been paid by the taxpayer themselves, with no reimbursement from an employer or anyone else. Rule 2. The expense must be directly connected to earning assessable income, not a general life cost, and not a future career ambition. Rule 3. There must be a record to prove it, a receipt, a bank statement, a logbook, a diary entry, something the ATO can verify. Get those 3 rules locked in because they apply to everything that follows. Now, let's talk deductions. Number 1 is working from home expenses, and this one catches people out more than almost any other category. Since the Australian Taxation Office updated its guidance, there are 2 methods eligible taxpayers can use. The first is the fixed rate method, currently set at 67 cents per hour worked from home. That covers electricity, internet costs, phone usage, stationery, and computer consumables, all bundled into a single hourly rate. To use it, a running record of hours worked from home must be kept throughout the income year, a timesheet, a diary, a roster, or similar document. The second option is the actual cost method, where each expense is calculated and claimed based on genuine work-related use. This method requires more detailed records, but can produce a larger deduction for those whose actual costs exceed what the fixed rate covers. What does not get covered? The mortgage or rent, the cost of coffee, general household items bought for personal use. The ATO draws a firm line here, and they're watching. Number 2, car and travel expenses. This is one of the most misunderstood deductions in Australia. Here's the critical point. The daily commute from home to a regular place of work is not claimable. The ATO is explicit on this. However, travel between different work locations, trips to clients, travel to conferences, or driving to pick up work supplies, all of that is legitimate. There are 2 approved methods. The cents per kilometer method allows a deduction of 88 cents per kilometer for the 2024-2025 income year, up to a maximum of 5,000 kilometers. No written evidence of the kilometers is required, but taxpayers do need to be able to explain how the calculation was made. The second method is the logbook method, where a logbook maintained for a continuous 12-week period establishes the work-related percentage of vehicle use. That percentage then applies to all vehicle expenses, fuel, insurance, registration, depreciation, for the entire year. And once a logbook is established, it remains valid for 5 years before a new one is needed. That's a significant advantage for those with high work-related driving. Number 3. Self-education expenses. Australians who study to maintain or improve the skills required for their current job can claim the cost of that education as a deduction. Course fees, textbooks, stationery, travel to and from classes, it can all be included. The crucial qualifier is that the education must relate to the current role, not a desired future role. Someone working as a nurse who studies an advanced nursing qualification, claimable. Someone working as a barista who studies a nursing degree hoping to change careers, not claimable. One important detail worth knowing: the course doesn't need to be completed to make the claim. If study was undertaken during the income year, those expenses are eligible regardless of whether the qualification was finished. Number 4 is income protection insurance, and this is one that catches people in the wrong direction. For income protection insurance held outside of superannuation, the premiums are fully tax deductible. The ATO allows this because the benefit, monthly payments if a taxpayer is unable to work due to illness or injury, would itself be assessable income when received. However, for income protection held inside a superannuation fund, the premiums are not directly deductible by the individual. They may be deductible to the fund, but that benefit doesn't flow through to the member's personal tax return. This distinction matters enormously, and many Australians don't realize they're holding the wrong structure. Number 5, capital gains tax strategy. This one goes beyond a single line item and into strategic territory, and it's worth understanding before June 30th. A strategy known as tax loss harvesting allows investors to sell underperforming assets before the end of the financial year to realize a capital loss. That loss can then be offset against capital gains made elsewhere during the same income year, reducing the overall CGT liability. Carried forward losses from prior years can also be applied. This can dramatically reduce or even eliminate a tax bill. There's one critical warning here: the ATO's wash sale provisions. If assets are sold to crystallize a loss and then immediately repurchased with the dominant purpose of obtaining a tax benefit, the ATO can disregard the loss entirely. The timing and intent of any asset disposal must be genuine. This is exactly the kind of strategy where a qualified accountant earns their fee easily and immediately. Number 6, and this is the one that could change everything: salary sacrificing into superannuation. This is the big one. Here's why it matters so much. The marginal tax rate for someone earning between $45,001 and $120,000 is 32.5%. For those earning between $120,001 and $180,000, it's 37%. But employer contributions and personal concessional contributions made into superannuation are taxed at just 15% inside the fund. That gap is pure savings. Every dollar redirected into super instead of hitting the top marginal rate delivers an immediate tax reduction. Through employer salary sacrifice arrangements, pre-tax income is directed straight into superannuation, reducing the taxable income before it's ever assessed. Alternatively, personal contributions made directly to super can be claimed as a deduction on the tax return, producing the same outcome. The concessional contributions cap for the 2024-25 year is $30,000, including any employer contributions already being made. And the June 30 deadline is hard. Contributions must be received by the Superfund before the end of the financial year to count for that year. Don't leave this until the last moment. Number 7, the cost of managing tax affairs. This one feels almost too simple, but it's real and it's claimable. Any fee paid to a registered tax agent, accountant, or BAS agent for preparing a tax return is deductible in the year it's paid. Tax software subscriptions, investment performance tracking platforms, fees for tax advice relating to investment decisions, travel to and from a tax agent's office, all of it qualifies. This means the very act of getting professional tax help generates a deduction on next year's return, so even the cost of optimizing a tax position is subsidized by the system itself. Here's the bottom line on all of this. The ATO operates a self-assessment system. It issues a tax return, provides the tools to file, and waits. It does not send a reminder about the 67-cent work-from-home rate. It does not flag that an income protection policy might be structured incorrectly. It does not suggest salary sacrificing before June 30. That responsibility sits entirely with the taxpayer or with a trusted accountant who knows the rules. The 7 deductions covered here are legitimate. They are ATO approved, legislated in the Tax Act, and used every year by millions of Australians who simply made the effort to understand them. working from home costs, car travel, self-education, income protection premiums, capital gains strategy, superannuation contributions, and the cost of getting professional advice. That's a powerful set of tools available right now. The financial year has a deadline. June 30 does not move. If any of these deductions apply to the current situation, and for most working Australians, several of them do, the time to act is before the clock runs out. If this video helped clarify even one deduction that was being missed, share it with someone who needs to hear it. Subscribe for more Australian finance content that cuts through the noise. And remember, the accountant's fee is deductible too.